Hi, this is Monty Agarwal for Uncommon Wisdom Daily TV. 2011 has been a challenging year for investors. Buy and hold strategies have not worked. Trend followers have been confused by sideways markets that suddenly lurch one way or the other. And even fundamental analysts have suffered. Unfortunately, I don't foresee things getting easier anytime soon. But you can still make money in these kind of markets. And the choices you make today may determine your net worth for many years to come. So how can you select investments that will not only add to your wealth in the short term, but preserve your capital for the long term? I have been a hedge fund manager for several years, and I use some of the more intricate hedge fund strategies to help subscribers to my $1 million rapid growth portfolio do just that. One of these strategies is the long-short approach, which takes advantage of the market turmoil in two ways. First, by pairing trades, that is, buying an asset that I feel is cheap and taking an inverse position in an asset that I feel is expensive. And second, by adjusting that mix to take a net long or a net short position in the portfolio based on the latest market news. Today, I want to share with you two individual trades which could help you utilize this long-short approach to great effect. Number one is long gold, short oil. The Spider Gold Trust ETF, GLD, gives you exposure to the safe haven of choice against depreciating currencies, falling stock markets, sovereign debt defaults, and geopolitical tensions. Plus, it's only a matter of time before the European Central Bank starts issuing Eurobonds. That will imply a devaluation of the euro and prompt an even faster flight into investors' favorite hard asset, which is gold. However, one factor that could derail a gold rally is a stronger US dollar. So to hedge this risk, I advise taking a short position in oil. You don't have to short it directly. Instead, there are a handful of short oil ETFs that can get you positioned correctly with a fraction of the risk. The second long-short trade I'm recommending is a bet on Africa and against Europe. Africa is rich in natural resources. It has young demographics and rising domestic consumption, increasing capital flows from smart money, and amazing return metrics over the last 10 years. In fact, the African markets have outperformed not just the S&P 500 over the past decade, but stocks in China and India as well. To benefit from this trend, take a long position in the Nile Pan-Africa Fund, ticker symbol NAFCX. At the same time, you can make the best of the debt crisis in Europe with the ProShares Ultra Short MSCI Europe Fund, ticker symbol EPV. Governments all across the continent are adopting severe austerity measures, which are reducing GDP and corporate profits and resulting in lower stock prices. And another advantage to buying this ETF is that it's denominated in euros, meaning a decline in the shared currency will give it an extra kick. Both of these trades are classic examples of the long-short approach that hedge fund managers love. Now, of course, the weight of the pairs needs to be changed from time to time based on market conditions. But if done right, this strategy will hedge your wealth and also give you peace of mind as you ride out the coming storms in the markets. I'm Monty Agarwal for Uncommon Wisdom Daily.